This is going to be one of the most important videos you watch on financial statements, because in this video we're going to be covering the most important financial statement there is, which is the cash flow statement. And we're also going to be taking a look at real actual examples from Amazon, Tesla, Starbucks for a better understanding of what a cash flow statement actually is. The reason why the cash flow statement is so important is because it does the most important thing any investor or business owner is concerned about. It tracks how much cash the business is actually making and actually has in its bank account. Now, hold on a second. You might be thinking, doesn't the income statement track how much money the company has in its bank account with net income? Yes and no. The problem with the income statement is that it also includes non-cash expenses like depreciation, which is not a real cash expense that the company has had to pay. So with these kinds of non-cash expenses distorting the real cash position, it's a huge problem if you want to track how much cash that the company actually has in the bank. So this is why the cash flow statement was born, so that you can actually track how much cash the company actually has in its bank account. Now, we're going to be breaking down a typical cash flow statement step by step. What you can see right here in front of you is the three financial statements, and we're going to be focusing on the cash flow statement. But if you are interested in learning about the balance sheet and the income statement, we do have separate videos for those. And this Excel module, which you see right here in front of you, this is from the Ultimate Investment Banking Interview Guide and Financial Modeling course. It's designed to help students answer technical interview questions. So, the cash flow statement. The aim of the cash flow statement is to track your cash position. So is to get from net income, which you will get from the last line item on your income statement. So this exact net income line is going to flow through into the cash flow statement and usually be the first starting line item. And this is how the income statement and cash flow statements are interconnected. So with the cash flow statement, it's separated into three main parts. You have at the very top here, your cash flow from operating activity. So this is essentially going to track your cash from your main operations. You then are going to track your cash activity from investment activities. And finally, we're going to track your cash flows from financing activity. And we're now going to go through this line by line. So the first starting line item is obviously going to be your starting cash position. Now, if you are going to be preparing a cash flow statement for the year, so you're going to assume that in the previous year, the company has generated some cash. So that's going to be your starting point. Then we're going to get net income from the income statement. Now remember from our video from the income statement, there are non-cash expenses. Now, this distorts the net income line item because this is not actually what we have in the bank account. We have to make some adjustments so that we can see exactly how much cash we have. So let's begin with these adjustments. The first sets of adjustments which we're going to make are going to be the non-cash expenses and revenue. So pretty much these line items are going to be from the income statement. So, depreciation. Now, depreciation, it's essentially an accounting term. It's how accountants record the loss of value on a physical asset. If you buy a brand new car at the start of the year, you use it throughout the year, at the end of the year, it's not worth the same. So that loss of value is encapsulated in depreciation, but it's not an expense which you've had to pay. You've only recorded it as an expense on the income statement for tax purposes, to reduce your taxes. But on the cash flow statement, we have to reverse that effect. We have to add back depreciation because again, it's a non-cash expense. Now in column T right here, I've added in some signs to help you understand exactly how this is going to affect your cash position. So when you increase depreciation, here you're going to have to add it back into your income statement. So it's going to add to your cash position. Then stock-based compensation. Again, this is instead of paying your staff cash salary, you pay them using the company stock. So not a real expense. So you have to add this back into your income. And amortization of intangible. Similar to depreciation. Now, depreciation is concerned with physical assets, so plant, machinery, cars, vans, equipment. Intangibles are concerned about your reputation, your intellectual property, your patents, and these can lose value over time as well. So you have to add this back into your net income because, again, it's not a real cash expense. Deferred income tax, again, here we know that we have to pay those taxes, but we just haven't paid them out yet. We're just delaying it. So what that means is we still have that cash, so we can add it back to our net income to get to our actual cash position. Goodwill impairment, again, not a real expense. It's just a way to revalue goodwill. Plant, property and equipment write down, again, not an actual cash expense, just a way for us to reduce our taxes. So we have to add these back into our net income line to get to our actual cash position. But not just that, there are also other line items that we have to add back and subtract. Now, changes in operating assets and liabilities. Now, this is very important because these are working capital line items, and working capital line items, this is something which is very important to understand, especially if you're going to go into investment banking. Working capital is essentially how much money the business needs in order to operate on a day-to-day basis. And this is essentially short-term assets and short-term liabilities. For those of you who don't really understand this, then take a look at the balance sheet video where I pretty much explain this. But essentially, your short-term assets have to finance your short-term liabilities. And the more working capital that your company needs, then the more cash your company needs to operate. And that's not good because then it's a drain on capital. So instead of having cash where you can invest to grow the business, your company needs it in order to just operate day by day. So because these represent a drain on cash, we have to make adjustments in order to actually get to our actual cash position. So let's start with accounts receivable. Now, this is a negative because accounts receivable essentially is saying that we are going to be receiving this cash, but we just haven't got it yet. We've delivered the goods and we've just gotten an IOU. We don't have the cash yet. So essentially, the higher the accounts receivable, it means that we just don't have that cash yet. And it's actually a drain on cash because, again, we just don't have the cash. We're just waiting for it to come. Then prepaid expenses. Now, this is something that, again, you prepaid a year's worth of electricity bills, utilities, but because of accrued accounting, you can only record that which you have consumed. So if at the end of January, you can only record the month of January's worth of utility, but the rest of it goes into prepaid. But because you've prepaid a whole 12 months, that's again a drain on cash. So you have to minus it from your cash position. Inventory. Now, inventory drains cash because if you buy inventory, you have to finance that with cash. So it takes away cash. Accounts payable. Now, this is the opposite of accounts receivable, where in accounts receivable, you're waiting for cash to come, which just hasn't come yet. In accounts payable, you just haven't paid out the cash yet, but you still have it with you. So it increases your cash position, hence the plus. Accrued expenses. Again, this is something that it's an expense which you have recognized, but you just haven't paid it out yet. Let's just say that it's in the middle of January, it's the 15th of January, and you own a business. You have your people, your staff, your employees working for you, but you just haven't paid them yet. At the end of January, that's payday, that's payroll, that's when you pay them. But until then, they have worked and you have incurred this expense, but you just haven't paid them for that yet. And because you haven't paid them yet, again, it's an accrued expense. You still have that cash, you just haven't paid it out yet. Hence why it's a plus. Deferred revenue. This is for things which you haven't delivered yet. For example, let's just say you've been paid $1 billion to build a huge complex, which is going to take 4 years. Now, at the end of the first year, you can only recognize the amount that you built during that 1 year. But for the other 3 years, it goes into deferred revenue. But you still have that cash. You just can't recognize it yet. So that's pretty much cash flow from operating activity. Let's have a quick little summary. So you start off with your net income. You then add back all of these non-cash expenses because, again, you haven't actually paid them out. They're not real expenses. You just recognize them as expenses for tax purposes on the income statement, which is good, but it distorts your real cash position. You then have to track the changes to your working capital because, again, working capital is a drain on cash. So you need to make adjustments to get to your actual cash position from operations. And that's the first part of the cash flow statement. Now let's take a look at cash flow from investment activities. Now, investment activities, pretty simple. Here you're investing. Either you're investing in your business or in another business. Essentially, whenever you're investing, you're using cash, so it's a drain on cash. So, the first one, changes in short-term investments. Let's think of this as buying shares in a company. Now, when you're going to be buying shares in a company, you're of course going to be using your cash, which you have, to buy those shares. So it's a drain on cash. So as this increases, it's going to take away cash. And when this decreases, it's going to give you cash. Because when it decreases, it means that you sold your shares, so you now get cash in return. Same thing for long-term investments. So capital expenditure or CapEx. Now this is when you're going to be investing in your own business. And this is actually very good because when a company expands, it needs more machinery, it needs more equipment, it needs more van to transport goods. So, which is good, it's expanding the company. But in order for you to expand the company, you have to buy those machinery, you have to buy those warehouses, you have to buy those vans. So it's taking cash away from you. Now, there are some issues with this. And again, this is not a CapEx video, which I think I should make. But again, do take a look at the financial modeling course for a more in-depth understanding of this. Sometimes this can be misleading, CapEx, because sometimes without understanding the proper context, a company might have they might have damaged their assets. So they might be incurring higher CapEx expenditure, not to grow the business, but to just maintain the business. And if you don't understand this, this is going to affect the way you build the financial model. It's going to affect your investment thesis. It's going to affect everything. So it's really important that you understand the context behind these numbers and not just not just look at them and take them as face value. But again, we go through that in the financial modeling course in a bit more detail. Next is PP&E sales proceed. Now, as you can imagine, if you're going to sell a factory, if you're going to sell machinery, it's going to be a cash influx into you. The opposite, you would tend to record as capital expenditure. So this is why I've only included a plus when it increases here. So that's essentially your cash flow from investment activities. Now let's take a look at cash flow from financing activity. Same rationale. Whenever cash is coming to you, you increase your cash position. Whenever cash is going away from you, it's a decrease. So the most common line item under financing activity is common dividend issuance, or if you're going to be paying out dividends. How do you pay out dividends? Using your cash. And whenever you pay out dividends, that reduces your cash balance. Hence a negative when this increases and a plus when this decreases. Because when it decreases, it means you're not paying out a dividend. So you get to keep that cash. So issuing long-term debt. Simple. Imagine going to the bank and say, hey, I need $1 billion. What do you think that's going to do to your balance sheet? It's going to increase your cash balance. So it's going to be an increase of cash. When you pay back that debt, it's going to be a decrease in cash. And exact same rationale for short-term debt issuance and short-term debt payments. So that's essentially cash flow from financing activity. So then you're going to add up all of these changes. And then you're also going to include your cash flow from the starting position. So the starting position plus all the changes which has taken place is going to give you your final cash position. And this final cash position is then going to link back into your balance sheet under current assets under your cash and cash equivalent right here. And this is how the ending cash flow line item links back into the balance sheet. And that's essentially your cash flow statement. Now, before we take a look at some real cash flow examples, I just wanted to let you know that this Excel module that you see right here in front of you is the same one which is in the investment banking interview guide and financial modeling course, which you can use to practice for the technical questions which you will get during your investment banking interviews. So if you are interested in breaking into investment banking, then do check out our video where I cover all the categories of questions which you need to prepare for in order to ace your interviews. And also check out our guides and courses, which has been used by thousands of candidates to land multiple interviews and job offers in investment banking from leading banks like Morgan Stanley, Credit Suisse, all the major bulge bracket banks and multiple middle market banks as well. And all the links are going to be in the description below. So now let's take a look at a few real examples. Let's start off with Amazon. So this right here is Amazon's statement of cash flow. And here you have the years, and on the left hand side are the line item. Now remember, at the very beginning it's going to give you the starting cash position, which we have right here. And then it's going to commence with net income, which is being fed through from the income statement. And after that, it's going to start making the non-cash adjustments. So adding back depreciation, adding back stock-based compensation, other operating expenses, deferred income. Again, these are things which distorts the actual cash position from net income. And then below that, you have changes in operating assets and liabilities. These are pretty much working capital line items, which you see right here. And then it's going to give you the cash flow from operating activity. Below that is going to give you the cash flows from investment activities. So here, the purchase of property and equipment. Again, because you're buying property and equipment, this is going to be a negative because it's an outflow of cash. Proceeds from PP&E, because you sold them, it's an inflow of cash. Acquisitions of cash acquired and other. So this is when you've acquired other assets. So again, you've acquired assets by paying via cash. And sales of marketable security. So let's just say you've sold shares and other derivatives. Because you sold it for cash, it's an inflow of cash. Again, the logic is exactly the same. Nothing really stands out here. Now, foreign currency effects is something which you do see on cash flow statements, especially with large companies, companies like Amazon, Tesla, Netflix, international companies which trade in different regions, different countries using different currencies. Whenever they convert foreign currency into the currency which they're reporting, in this case the US dollar, sometimes there is a surplus effect. It's an appreciation effect, and sometimes these can be large. It can be a good effect. So like in this case, there was an addition of 713 million because of this, but then in the next year it was negative 351 million. So not necessarily material, although it can be for some companies. Like in this case, it can add some effect. But in the most recent years, it's only been 70 million. So not very material, unlike this year right here. Now let's take a look at Starbucks. Starbucks is not always the easiest one to take a look at, but essentially, again, they start off with net income, and then they make our non-cash adjustments by adding it back, and then you also make adjustments to your working capital to give you your cash flow from operating activities right here. Below that, you have cash flow from investment activities. Again, here, whatever you're going to be buying is going to be an outflow of cash. Whatever you're going to be selling is going to give you cash. Exact same logic on financing activity. So nothing really stands out here. So now let's take a look at Tesla. Now Tesla is always pretty interesting because, again, depending on the business, they will have specific line items which will affect their cash. And right here, again, this is Tesla. You see foreign currency transaction gain or loss is within an adjustment that they have at the very top. It's not at the bottom. So again, it's just a different way of presenting it, but you still have to make an adjustment for these things. So again, you start off with, in this case, a net loss that they didn't make any income. You then add back any depreciation, amortization, any non-cash expenses. You then make adjustments for working capital line items, which is going to affect your cash position, because again, working capital is a drain on cash. And then you make adjustments for cash flow from investment activity. Nothing major, which is interesting here. Purchase of solar energy system. It's interesting that they highlighted this as a specific line item, probably because it's quite material. You then have cash flow from financing activity. Tesla's capital structure is very, very complicated, as you can see here. And I don't have time to go through every single one of them, but you can pretty much see just how complex their capital structure is, the way that they finance their operation. Again, Tesla is historically has been a loss-making company, so you can understand why it's pretty complex, the way they finance their operation. But essentially, nothing really stands out. Now, Apple is very easy to read. Again, you have your previous or your starting cash balance at the very top, and then your net income, and then you add back your non-cash expenses such as depreciation. You make adjustments for your working capital line item, which are found in the balance sheet. And then you also take a look at your investment activity. Because Apple has a lot of cash on the balance sheet, you would expect they would want to capitalize or make use of their cash balance by investing. So this is why they have a few investment line items compared to other businesses. Financing activities shouldn't be that complex because again, they are pretty self-sustaining. And at the very end, you have the ending cash balance, which again feeds into their current assets on the balance sheet as cash. And that's pretty much it for the cash flow statement. If you are interested in learning about the income statement or the balance sheet, then do check out our videos on that. And as usual, stay tuned, subscribe, and like this video if it has helped you. And there will be more videos on the topic of financial statements.